Good morning to all of you. Good afternoon to our colleagues that are in Europe, or Guten Tag, and to our colleagues further south, bienvenidos and buen dia. I just came back from the STEP LATAM conference, and so I've been immersed in Spanish, and then I'm heading off to the IR Global event in Berlin. So I'm trying to brush up on my German. So there you go. You got all about everything I've got. Welcome, though, to our U.S. Taxation and Foreign Trust Boot Camp. Before I introduce my co-presenter, I just have a couple of items to address. This is a recorded session, so please turn off your mics and cameras if you do not wish to be heard or seen. We do have a privacy policy. We respect your privacy, and if you have further questions, please see our written privacy policy or contact us directly. Big disclaimer: this discussion is for informational purposes only. Don't believe anything we say. No. Nothing, however, should be construed as legal or tax advice. So don't go home and say, this is what Milan or Amy said, and this is how we should do it. You should seek proper advice. And the last warning is because of Amy in past presentations, is that we ask that no minors be present, because sometimes there might be some things said that could be inappropriate for minors. Just a joke. No. On a much more serious note, I would like to introduce Amy Jetel, who has been kind enough to share her time as well as her wealth of experience and knowledge in this area. She is an ACTEC Fellow, which is the American College of Trust and Estate Counsel. That's really a fancy way of saying she's just very smart and knows what she's doing. And last but not least, she's a STEP board member. Amy's also done a lot of writing, and I've read some of her articles. They're very good. So we're very fortunate to have Amy with us here today. And a brief introduction about myself. I started out working with the IRS as a trial attorney, and then spent a fair portion of my career living and working in Switzerland, heavily involved in the voluntary disclosure program, and then now back based in the United States for the time being, at least. So on with the show. We have a lot to cover, so we're going to try and cover everything, but also we're going to cover it at a high level. So if anyone has any questions, please write to us if we don't have enough time to take questions and answers at the end. So let me start with we've broken this up into 3 parts. The first part, which I'm going to cover, is classification of trust for U.S. tax purposes. Then once we get in, and I'll explain why, and then Amy's going to cover the taxation of the trust for U.S. tax purposes once it's been classified. And then the last part is going to be briefly on the reporting requirements, because it's a necessary evil here. And hopefully, and I think we should have enough time to get to what we really enjoy, which is our special issues, where we get to talk a little bit about issues we've encountered and how we've dealt with them. So let me get to the classification of trust for U.S. tax purposes. There's 4 items for 4 classifications, and really 3 when it comes to foreign trust. The first classification is it a trust? We'll get into that briefly. Then once you've determined if it's a trust, is it a foreign trust or a domestic trust? And then once we've determined, and for this purpose of this webinar, if it's a foreign trust, is it a foreign grantor trust or a foreign non-grantor trust? And the last item, as I said, we're simply mentioning it. It's whether it's a simple or complex trust. It's really not relevant when it comes to foreign trusts. Okay, so is it a trust? Very briefly, there is no specific definition for a trust under the Internal Revenue Code. It's the classification of it, whether it's a trust or not, is primarily based on regulations, administrative principles, and some case law. The key features of what is a trust for U.S. tax purposes: there's a fiduciary arrangement, There's a trustee that manages assets, and then there are beneficiaries that are passive. Where this comes up in the context of, because we're trying to classify, is this a trust or not a trust? Obviously, in English, if it says it's a trust, more likely than not, it will be a trust. But then when we start getting into more non-U.S. or common law type trusts, then we get into some issues. We've pointed out a couple here, such as the Mexican Land Trust. Actually, Amy was heavily involved in getting that revenue ruling passed. So thank you, Amy, for that and getting clarification on that issue. When I was doing the voluntary disclosures, this chief counsel memorandum was somewhat helpful with regard to Liechtenstein Anstalts and Stiftungen. And being in Europe, I dealt a lot with the use of FRUCT, and I'm sure Amy has with the Latin American markets. At the end of the day, when it comes to non-U.S. arrangements, it's very heavily based on the facts and circumstances. So it's basically something I would not recommend you do at home alone. So once we've determined it's a trust, then the next step is it a foreign or domestic trust? And this is an interesting rule for U.S. tax purposes. Under U.S. tax rules, a trust, once we've determined it's a trust, is a foreign trust by default, and only if it meets the court test and control test does it become a domestic trust. And it's important to know if it's a foreign trust versus a domestic trust, because it determines the taxation, what rules apply. So it is a key thing, but the court test and the control test determine whether it becomes a domestic trust. Otherwise, by default, it's a foreign trust for U.S. tax purposes. So briefly, what is the court test? The court test is where a U.S. court has primary supervision over trust administration. In other words, is Nevada the law of the trust? Is Wyoming the law of the trust? That's kind of the first test. That's the court test. The control test is a little bit more nebulous. It deals with substantial decisions. I'm not going to get into too much detail here because of the time, but essentially it can be good, it can be bad, because it can surprise you if you're not aware of it. It can be good because it allows you to control whether you have a foreign or a domestic trust, depending on what outcome you want. So it gives you flexibility as well. So the control test can be a good thing if you're aware of it and you can control it. It can be a bad thing if you get surprised by it, because, for instance, one time someone thought they had a domestic trust, but they gave power to a non-U.S. person for investment purposes. That's substantial decision control. That caused it to be a foreign trust, and they didn't realize it. So you can see.
So I want to be clear, Milan, investment control, that doesn't mean, the trustee hires a foreign investment advisor. It means like someone under the trust document in their capacity as some fiduciary, something has power to direct investments. And right.
Thank you for that. So those are the two items, and that determines whether, in fact, if it's foreign or domestic. So now we're going to focus solely on the foreign, since that's our topic. So once we've determined that it's a foreign trust, so meaning it either fails either of the two tests or both of the tests, then once again, it matters because it determines now who's going to pay the tax. Amy's going to get into more detail about who's the taxation and who's paying the tax. So I'm just going to cover it very briefly. If you have now with regard to a foreign grantor trust, we're going to focus on that. It breaks down into two parts. It's either a U.S. grantor. And when I use the term grantor, just so for the non-U.S. Audience, grantor and settlor are basically synonymous. So in the U.S., we use grantor, or under civil law, under common law, and what you most likely see outside the U.S. is the term settlor. And more technically, the grantor settlor is, for U.S. tax purposes, the owner of the trust. Okay, so that's just a technicality. At the end of the day, you have two types of grantor/settlors. It's either a U.S. person, grantor, or a non-U.S. person grantor. If you have a U.S. person grantor, the default rule, which applies, I would say, I don't know, almost 90% of the time, where a U.S. grantor transfers funds to a foreign trust, it's going to by default be a grantor trust under this rule, under 679, which is an automatic rule. There's a more there's a more unusual circumstance where it goes into a trust that's a foreign trust where it prohibits U.S. beneficiaries. That has to be very clearly stated. And in that situation, if the grantor, U.S. person grantor, retains certain powers, it will still be treated as a grantor trust. Amy will get into the taxation of that, so I am not going to touch that. I left all the hard work for Amy. Then, if you have a non-U.S. grantor, vice versa, it's a foreign non-grantor trust unless it meets either of these two exceptions. So, in other words, if you have a non-U.S. grantor for a foreign trust, it by default will be a foreign non-grantor trust unless one of these two exceptions apply. The first one is that the grantor settlor has the power to revest the property or the title of the assets to themselves. Or the second exception is where the non-U.S. grantor during the lifetime has the power to distribute corpus or income to only the grantor or the grantor's spouse. Those are the only two exceptions. Otherwise, you're with a foreign non-grantor trust. Now, I will just quickly tell you, this is, and Amy's going to get into this, this is heaven for U.S. tax planning purposes. This is where you want to be with respect to U.S. taxes. Foreign grantor trust. Just remember that. This is where you probably want to either be wary or know where you are, because this could turn into hell. Foreign non-grantor trust world. Amy's going to get into the tax issues, but I'm going to just highlight them. Throwback tax rules. She'll get to it. Saving the good stuff for later for Amy. At the end of the day, if it doesn't qualify as a grantor trust, it's a foreign non-grantor trust. And this is where the nasty tax rules come into play that Amy's going to get into. Last item, I think we just said, Amy and I mentioned this simply because we didn't want someone to think we overlooked it. In the foreign trust world for U.S. tax purposes, it's really not that relevant, but you may hear someone say, by and large, foreign trusts are complex because of the fact that trustees have discretion over distributions and other reasons why. So it doesn't really have a tax impact for our purposes. And we'll be sharing the slides. So at the end of this, you can get these slides and there's a summary for the classification of trusts. Okay, Amy, I went a couple minutes over, sorry.
Oh, that's all right. Okay, so we're going to talk about the U.S. taxation of foreign grantor and non-grantor trusts. And there's nothing on that slide. There we go. Okay, so this is a narrative depiction of the picture on the next slide. So these two slides go together. If you like words versus pictures, I like pictures. So if we have a foreign trust with a U.S. owner, the grantor's the owner, then so remember that it's a U.S. person, a U.S. grantor is going to be treated as the owner of that trust. Therefore, it's going to be a grantor trust as to a U.S. person. Pretty much 99.999% of the time, if a U.S. person creates a foreign trust. And so we call that kind of the automatic rule. And so you have to but if you happen to be able to draft or weasel your way out of foreign grantor trust status as to that U.S. person, you still have to look at whether that U.S. person retained any kind of impermissible, so to speak, powers over the trust to cause it to be a grantor trust. End result, we'll call it the, 99.99% of the time, it's going to be a grantor trust as to the U.S. person. The result being that U.S. person, it's a pass-through completely. Like it's as if the trust doesn't exist, essentially, for tax purposes. So all the income flows through onto the U.S. owner's tax return. There are some additional reporting requirements that we quickly go over later. All right, so this again is a narrative of U.S. taxation of a foreign grantor trust with a non-U.S. owner, and here's the pictures. So if you have a non-U.S. grantor, so keep in mind, the IRS doesn't like it if there's a non-U.S. owner because it creates an amazing situation from a U.S. tax standpoint, and the IRS doesn't like amazing situations. They like taxable situations. So opposite of a U.S. grantor that has an automatic, classification as a grantor trust, with a non-U.S. grantor, it's almost kind of automatic that it's not going to be a grantor trust, and because there's only two ways to get there. And usually those ways don't work in the non-U.S. grantor's home jurisdiction for tax purposes. First way is that the non-U.S. grantor must essentially be able to revoke the trust, have an unfettered right to revoke the trust, or only that U.S. grantor or his or her spouse is the sole beneficiary, basically, of the trust during the grantor's lifetime. So if you don't fit into one of those two exceptions, or if you do fit into one of those two exceptions, we're going to have a trust with a foreign owner. Okay. So just like if the trust had a U.S. owner, all of the trust income is deemed to be taxable to the foreign person. Deemed to be. So if that foreign person's sitting off in a foreign jurisdiction and it only has, non-U.S. income, you can see why the IRS does not like this and why they've limited it.
Yeah. Nirvana from a U.S. tax perspective.
Nirvana. So, okay. All right. If you're in that, realm of not being able to have an owner of a trust, of a foreign trust, either a U.S. one or a foreign one, now we're in foreign non-grantor trust land, which is what this whole thing is about. So it took us a long time to get to this is what we're talking about. So foreign non-grantor trust is itself treated like a non-resident alien from a U.S. tax perspective. And so that foreign non-grantor trust, it doesn't file a U.S. tax return unless there's certain types of, business income, or if certain other types of U.S. source income not fully withheld. So I think that's
it.
I think that's about that. Yeah. Okay. So, all right. So we are in U.S. taxation of U.S. beneficiaries of a foreign non-grantor trust. So, if we didn't have any U.S. beneficiaries at all, we wouldn't be talking about this because this is what this whole thing's about. So one thing to remember is that U.S. beneficiaries are going to be subject to U.S. taxation on any distributions that they receive from that foreign non-grantor trust. And the Internal Revenue Code has a tiering rule or an ordering rule for any distributions from such a trust. So the first thing that is forced out on that distribution is the current year's income, known as D&I, distributable net income. Once all the D&I is depleted, then any income accumulated from a prior year that was not distributed, or U&I, undistributed net income, comes out. And that's the thing that everybody's scared of, is the U&I. And we'll talk about that. And then and only then, after that distribution, if it's large enough, has carried out all of the current year D&I, past year U&I, then we get into it being deemed to consist of non-taxable corpus.
Amy, do you mind? I just want to explain one concept before you get into the technical things here.
Yeah.
Just for the audience to understand, make it clear, is that why these rules come into play that Amy's going to get into a little bit more detail, is that the U.S. doesn't like deferral of income. And when you have a foreign Non-grantor trust, from a U.S. perspective, the U.S. cannot tax that trust because it's foreign, it's not U.S. It's considered an NRA, non-resident alien, unless there's U.S. source income. There's small technicality there. So what can happen is it gives it preferential treatment if you have U.S. beneficiaries because income can accumulate in that trust vis-a-vis a U.S. domestic trust or a foreign foreign grantor trust that's taxable to a U.S. grantor. It gives a tax advantage. And so these rules are, they're essentially punitive. And that's why we have these rules, because it can cause deferral of income.
Yeah. Okay, so this is just the ordering rule in graphic form. So let's take an example. A foreign non-grantor trust makes a $400 distribution to a U.S. beneficiary. The trust has $100 of current year DNI, $200 of prior year accumulated income, and UNI. So on that, this is how the ordering rules work. When that $400 distribution is made, what's deemed to first come out is the $100 of DNI, and then you dip into the UNI to the tune of $200, and then the excess of $100 is corpus. And you can see the $100 subject to tax, $200 subject to tax, and the throwback tax that we'll talk about, $100 not taxable because it's corpus. All right. I don't want to get too deep. Okay.
Yeah.
So U.S. taxation of beneficiaries. So the DNI include there's some kind of difference. Here's where we start to get into differences between a U.S. non-grantor trust and foreign non-grantor trust. So DNI of a foreign non-grantor trust is all the income earned by the trust during the current year. It includes normal things like interest, dividends, rents, royalties, things like that. But it also includes realized capital gains, which is not like U.S. grantor trusts. And the reason being that, just like Milan said, the IRS doesn't like there to be a potential for deferred taxation of income. And so it's deemed to be part of the DNI. DNI, when distributed, current year DNI, it retains its character once it's distributed and passed through to the beneficiary. So qualified dividends remain qualified, lower tax rate, long-term capital gains get their preferential rates, all of that. U.S. beneficiaries have to each report their pro rata share of DNI on their U.S. tax returns. Keep in mind that if distributions are less than or equal to DNI, then you're good. It's just like kind of, clicking along. You don't have to worry about the throwback tax. But what happens if a foreign non-grantor trust distributes more than the DNI? Well, then it's going to be called an accumulation distribution. And accumulation distributions are subject to this thing called the throwback tax, which is really just, in all honesty, it's a fancy sounding term for an interest charge on that income, because the IRS thinks that just because, this trust didn't pay it in the past, that they were entitled to receive the income way back when. So they're going to charge the beneficiary interest. So here's some also punitive things is that, all those preferential tax rates on qualified dividends and long-term capital gains, those go away, get stripped of their character. Another punitive thing is that the U.S. beneficiary is going to be hit with that UNI, even if it accumulated before they were born, even if it accumulated before the U.S. beneficiary became a U.S. person, so they're going to get whacked with all of it. All right. So throwback tax mechanics, here's where I don't want to make people's head totally spin. But keep in mind, if there's an accumulation distribution, the UNI that comes out gets subject to regular tax. It's essentially as though the U.S. beneficiary is filing an amended return to report that accumulated income. And so they pay regular tax on it, just like if you failed to pay tax and file an amended return. And then there's an interest charge compounded daily, all the way back. Who knows how many years? 30 years, could be. So the practical effect is that some old U&I could potentially be consumed by the throwback tax. So, hey, beneficiary, you're getting $1 million distribution. Oopsie, now you got to pay that $1 million over to the IRS. So, all right, did I get everything there that you want me to?
Yeah.
Oh, good. This is you.
Yeah. So Amy, this is my favorite slide. So Amy's been kind enough to let me interject. While Amy went through all the heavy lifting and the explanation of how the DNI and the UNI and the capital corpus is taxed with the foreign non-grantor trust, I like this because it's just basically a visualization of what happens. And as you can see with the graph with the curved yellow curve up. So if you have $100 distribution of UNI, because of this throwback tax, because of the interest charge, and based on the amount of time, this is an estimation because it's obviously based on facts and circumstances. Essentially, when you start getting to about 10 years of accumulated income, and somewhere between 10 and say 16, 17 years, usually say between 10 and 20 years, that, as Amy mentioned, the entire amount is consumed by the throwback tax. It's devastating. This is why a lot of the work that we do is either trying to mitigate the problem, which Amy's going to get into, or avoiding it. So that's where the planning comes in and is very critical and important when you're going to have U.S. beneficiaries of foreign trusts.
All right. So how do we mitigate the problem? There's essentially, I think we talked about 3 strategies. The first and most popular being what we call the election strategies. And the most commonly used one to mitigate and avoid the creation of UNI at all, and of course, you got to get in early on this game. Sometimes we inherit trusts that already have UNI. But the trustee distributes all the DNI to the beneficiary each year. There's also some fancy dancy things, this default method of calculating what's kind of a little bit too much in the weeds. And then that third one is up there, but I'm not going to talk about it because I'm running out of time. Okay.
3 minutes.
Yeah. So distribution strategies. So I want you to keep in mind that most of these distribution strategies, what happens is, so like, let's look at the 3 bullet points: distributing a specific sum of money or property, mandatory income distributions. Those 2 actually, they don't, under the rules, these types of distributions do not carry out DNI or UNI to the beneficiary at all. Now that's nice, right? Because the beneficiary can get some money in their hands, but the DNI is not carried out, meaning that there's not a deduction on the trust level. Now a UNI is being created. So, you may be kind of out of the frying pan into the fire kind of thing, but keep those in mind. All right, last mitigation is restructuring and investment strategies. Milan's personal favorite, which I think we'll talk about later, is kind of restructuring the trust to grant a general power of appointment to another non-U.S. person, resettle the trust or appoint the trust assets. Sometimes if the grantor is alive, and sometimes they can get a distribution and do the whole thing new to another one. Domesticate, decant, restructure. Investment strategies, investments in U.S. tax exempt bonds don't generate DNI. You could just buy and hold appreciating stock. As long as you don't sell it, it's not realized capital gains, so it doesn't become DNI. And then what Milan would call my personal favorite is investing into U.S. compliant life insurance policies, PPLI.
That's how I got to know Amy, through her articles on PPLI. So yeah. Anyway, side note.
All right.
Okay. Now we're back to where I start talking about reporting, exciting stuff. So I'll try to get through this quick so we can get to the fun stuff. But it is important to know the reporting, because that's kind of where the rubber meets the road. When we've talked about the classification, Amy's talked about the taxation, but at the end of the day, the IRS wants this information. And when it comes to foreign tax reporting, the IRS wants a lot of information. Not all of it's necessarily taxation, but it's information because they want to know what's going on because they don't get information reported to them automatically. So they're just in constant paranoia that people are hiding money, not paying taxes. So they want to know everything. So Uncle Sam wants you to pay your taxes, basically. So when it comes to trusts, and those are the only forms I'm going to really focus on, the main ones are two. The first one is the 3520A. This is really when when Amy mentioned like 99.9999% of U.S. grantors who create a foreign trust, and under the automatic rule, it's a grantor trust. They have to fill out this 3520A. And the interesting part about that is the responsibility falls on the grantor, but the actual filing is supposed to be done by the trustee. So the trustee is supposed to file it, but the obligation is on the trustee, but the responsibility is on the grantor, U.S. person grantor.
Which, can I do a little editorial comment on that? Because
of course.
It just cracks me up every time I see a rule like this, because the U.S. government like tries to make everybody believe that the entire world is under its taxation jurisdiction. Right. Yeah. But then when you look at the actual rule, you're like, oh, but the U.S. owner is the only person that the IRS actually has jurisdiction over. And so it's just one of those like smoke and mirror things that cracks me up about our tax system over here.
I think that kind of is a good segue just into another point, which is if you have a foreign trust for U.S. tax purposes, if you don't have a U.S. agent, here again, the U.S. doesn't really have any authority then over that. So what do they make you do? They make you file all the papers. They want to see amendments. They want to see the original deed. They want to see future memorandum of understanding, everything. If you don't provide a U.S. agent. Why? Because they don't have any authority to get the records themselves without going through very difficult process. So if there's a U.S. agent appointed, Amy and I serve as those many times, it alleviates the trustees from having to provide all that information, which there's a lot of stuff in there that you don't want the government to have. Not for illegal reasons, it's personal, it's private.
And it's a pain too, like, attaching all that.
And it's a pain, and you have to update it. So yeah, it's a total pain. And you can avoid all that by having a U.S. agent appointed. And if the trustee for some reason fails to provide the 3528, in this situation, a U.S. grantor can do a substitute. But that's hopefully not a problem. Then the other main form is the 3520. For a U.S. grantor, they always have to complete Part 2, which is where they're the owner of the foreign trust. And then if they receive a distribution, that is the grantor also receives a distribution in that particular year, they have to fill out Part 3. And if, let's say it's the first year where they created the trust and they funded the trust, they would have to fill out Part 1. So in that situation, the owner's filling out 1, 2, and 3. I just threw in Part 4 because it's the same form that's used for reporting gifts from non-U.S. persons that are over $100,000, as well as from inheritances that are over $100,000, with this minor exception of the $19,570, which is adjusted for inflation. Thank you, Amy, for pointing that out.
So I think someone has their hand raised, and I would ask if you have a question, maybe put it in the chat.
Yes, if you have a question, please put it in the chat, and then we'll try to get to it and when we get to the end part. Thank you.
Okay, thank you.
The issue there is that many times I've seen this, and probably you have too, Amy, is that you have a foreign trust, an underlying company, and people don't want to go through the rigmarole of pushing it back up to the trust and then giving it to the grantor so that it would be a non-reportable gift under $100,000 or simply Part 4. And what happens here is that if you make the distribution from the underlying company, the threshold drops to $19,507. And if you don't provide the information, it's then deemed income for the beneficiary, that U.S. person beneficiary. So it's somewhere where we'll get into a little bit more, but I just wanted to highlight that.
Yeah.
So 3520 is also the form where you have a foreign non-grantor trust with U.S. beneficiaries that receive a distribution. They fill out Part 3. And now I'm just going to go through and point out there's a lot of reporting, so I'm not going to get into it. They're all here. You can read it tonight to help you go to sleep.
Yeah, I'm already getting bored. Let's get it.
Exactly. Okay, here's something. Here's something that won't
this is
bore you.
exciting. This is exciting.
This is exciting or scary. If you don't properly report, the penalties are significant. They are the greater of 10,000 or 35% of the gross reportable amount. These are serious penalties and fines, and they're automatic on most of them except for Part 4. So if you fail, if you're late, I'm fighting one right now. It's a weird case, but anyway, it's been going on for 3 years, and it's a large number because it's the 35% amount. So it's a large number. So penalties are significant. Important that you file or get advice on what you need to file. If there's a problem, though, there is some relief. There are some waiver for reasonable cause or non-willful neglect. There are programs that allow you to go through the IRS to declare the foot faults, I'll call them. These are non-willful cases. If they're willful, it's a little bit more complicated, but it can also be addressed as long as you go to the IRS before they come to you. That's the key.
Yeah.
Wow, Amy, I'm done. Maybe there was one question, so maybe we can answer that first.
Let me look. Let's see. Okay, does this reporting rule apply even to trusts established outside the U.S. that have U.S. beneficiaries, or only trusts established in the U.S. that are considered foreign grantor trusts? So I think that this reporting rule, I think I saw you raising your hand during the 3520, 3520A discussion. So those apply to trusts established outside the U.S. So 3520A is a foreign trust that has a U.S. owner, essentially. And the 3520 is basically, I see that also as like, it's also a beneficiary form. So a U.S. beneficiary receives a distribution from a foreign trust, whether it's grantor or non-grantor. But the U.S. grantor also has to file a 3520.
Yeah.
So, or only to trusts established in the U.S. that are. So I hope that answered the question. Is that kind of how you're reading it, Milan?
Yeah, the one thing, because it says if the trust is established outside the U.S. versus if it's established inside the U.S. I just want to clarify there. It's not where the trust is established. Going back to the first part, it's the classification. Is it a domestic trust or is it a foreign trust? So if it's a foreign trust by classification, then the reporting applies, the 3520 or the 3520A, whichever is applicable. Once it's foreign, the U.S. wants to know everything. That's pretty much the sum.
Right.
So these are the forms. We're not going to get into those because it's just boring. They're there for you to read. Okay. So thank you for that question, though. I think that helps clarify an important point. It's because, and this actually kind of gets into, it's a good segue into your issue, Amy, right? On the hybrid trust and the reverse hybrid trust.
Right. Yeah. So maybe this will kind of clarify some of that question about established in or out. Okay. So we talked about the foreign and domestic trust tax classification rules. So normally when a U.S., and this is kind of like when a U.S. person creates a foreign trust, like we said, it's normally going to be, it's foreign and it's a grantor trust and it's foreign for tax purposes. Well, there are some weird situations where a U.S. grantor may want to have a trust that is like governed by Liechtenstein law, administered a whole lot in Liechtenstein, but does not want it to be tax classified as a foreign trust. And so what we do is we kind of play with those control test, court test rules to allow the trust to be kind of foreign for all trust law purposes, but U.S. for federal income tax purposes, which means that none of those 3520, 3520A apply. So, and then the opposite of that, which is normally used by non-U.S. grantors, is which is a reverse hybrid trust. They'll say, you know, I kind of want to take advantage of the laws of Wyoming, and I want to have a Wyoming trustee, and you know, all of that stuff, have it be a Wyoming trust for all trust law purposes. But I don't want it to be a U.S. trust for tax purposes because I'm a foreign person and all my family members are foreign. Why the heck would I want to create a U.S. taxpayer, you know, via a U.S. trust? And so and this is real easy to do. You just kind of have it fail the control test. You know, you give up one foreign person control over a substantial decision, and it becomes a foreign trust for tax purposes, but it's a Wyoming trust for all other purposes, including like common reporting standard and things like that. So you can kind of get a glimpse of why some foreign families might want to do that. So Milan, did you want to talk about?
Yeah, I'll talk about the next year. I just wanted to add to yours if I can. So this is what you and I saw quite a bit after 2019 with the implementation of CRS. And I'm not saying we're not saying why the purpose behind it was, but there's a timing where CRS came into place, and we noticed that there were trusts migrating, particularly from Latin America into the U.S. But of course, as you pointed out, they did not want to be taxed to the U.S. Why would you do that? That's crazy. Yeah. So that's where we saw a lot of this reverse hybrid trust come up. And kind of segueing back to the question, nevertheless, if there are U.S. beneficiaries, there is reporting. Even if it's a Wyoming trust with a Wyoming trustee, and the law is Wyoming. But if we fail the control test intentionally, that's a foreign trust.
Yeah.
With reporting.
Yeah, right. Exactly. Yeah. And actually the only structures like that I've worked on, it's like the whole family is foreign, you know, like completely. So, but hey, you know, if a U.S. person's born into the class of beneficiaries in the future, and it's a foreign non-grantor trust, remember, they're going to get smacked with the U&I going back to whenever the trust was created. So be careful.
Yeah. So I'm going to tackle or address the issue that both Amy and I think sneaks up on a lot of people in this planning. They're very familiar with the income tax. Like we said, a foreign grantor trust is nirvana from a U.S. tax perspective. A foreign non-grantor trust could have some potential problems if you're not aware of it, right? But what I think sometimes gets overlooked is the estate tax issue. So people, even if they have no U.S. beneficiaries, they're looking to invest in the U.S. and they're using trust to invest in the U.S. Well, the U.S. will look to what's called U.S. situs assets. And for U.S. persons, U.S. domiciliaries to be more exact, if you are deemed to be a U.S. domiciliary, you have an estate and gift tax exemption that will be $15 million per person starting next year. If you are a non-U.S. person and you have U.S. situs assets, your estate tax exemption is $60,000. It's basically nada. Nine. What happens here is that people aren't aware of this estate tax issue and they pass away. And clients think they're not going to die, but I got news for you. Your clients are going to die. And I know you know this because they all think they're not going to die, but they will die. And so it's important to
talk about it.
They don't want to talk about it. And it's important to be aware of the estate tax issue. There are ways to handle it. A blocker is one way. It's a little complicated. It'd be a whole nother session for us to go through that, but be aware of that estate tax issue, which kind of ties into the next point, which is
Yeah.
the Form 5173. Because if your client is a non-U.S. person and they bought real estate, or they have other U.S. sites that they have an E-Trade account, they have a Morgan Stanley account, and they pass away with owning Apple stock, if they don't get this if they didn't structure it properly with a blocker, they're going to have an estate tax issue, one. And even if the estate tax, let's say if they're below 60,000, which is probably hard to believe, but that's possible. Even if they're below, they have to get this clearance certificate, because the custodian of those assets will not release these assets to the estate without that certificate, because otherwise they're personally liable for the tax. So I had a unfortunate case where a husband passed away. The wife, he had shares. He worked for Google and had shares of Google, and the wife had 2 young children. And we were scrambling to get the transfer certificate, because despite the circumstances and the hardships, the custodian would not relent at all until we got that certificate, and it took a while. So anyway, word of caution.
Yeah. And yet another example of the IRS knowing that it only has jurisdiction over U.S. people, right? So it's going to leave the custodian holding the bag for the estate tax liability if they don't get this taken care of. So,
or if there's even no estate tax, but the custodian will never take any risk until they get that certificate.
Yeah, we know that about U.S. custodians.
Exactly.
Okay, so I think the next one's mine, strategic distributions.
I think so, yeah.
Okay, so we've been talking about the taxation, pretty much, of U.S. beneficiaries of foreign non-grantor trusts, which has this punitive aspect to it of you and I being subject to the throwback tax, which could eat up the whole distribution. So recall that. All right. So, but those rules don't say that a foreign trustee has to make a distribution to a U.S. beneficiary. And so and I actually run into this a lot, you've got a class of beneficiaries. Some are U.S., some are non-U.S. So we just follow the IRS's rules of ordering, right? And you make a distribution out to the non-U.S. beneficiaries in year 1 to cleanse out the U and I, potentially. I mean, you got to like run the numbers in terms of fairness, whatever. But you could cleanse all that U and I out of the foreign non-grantor trust, potentially, by just making a legit distribution to one of the foreign beneficiaries. And then the next year you can start making D&I distributions and, go forth and, worry no more, as you could say.
Yeah.
Now, Milan likes to make fun of me when I say, don't be cute. I don't know why you think that's funny, but, we're all smart here, right? And creative, and a lot more creative than than our U.S. Congress, to be honest, because they're constantly running around trying to pass laws to close loopholes that we come up with. So I know what you're thinking. Oh, okay. Well, I could make a distribution to a foreign beneficiary and then have that foreign beneficiary give it to my U.S. No, you can't. Like, loophole closed, can't do that. So, also you have to be careful about, don't make the big gigantic distribution out to all the beneficiaries, U.S. and non-U.S. in one year. You can't just allocate you and I to the non-U.S. beneficiaries. It goes out pro rata, which is why you have to do the staggering distribution thing. One tax year, next tax year. Okay.
Amy, the reason I laugh about that is because I've heard it so many times. Oh, that I get the solution. We'll just bypass the U.S. and go to this person and then get it to the U.S. person. Yeah. No, it's too cute. That's why I laugh.
Yeah. If it feels too cute and too creative and too good to be true, it's probably the case.
It probably is. Yeah.
Yeah. Okay. Do you want to talk about the general power of appointment?
I do. I've been dying to talk. And I just made the connection. Okay, so GPO, this is one of the mitigation techniques when potentially you have a situation with a foreign non-grantor trust with a buildup of you and I. You're like, oh, SHIT. What do I do? And I love this because it's a special situation. It has to work with trusted people and the right circumstances. But the connection I made is it's like nirvana, or really rebirth. So it's my Indian roots, right? So you start out with a beautiful foreign grantor trust. It's no U.S. taxation. It's wonderful. Then your client who doesn't think they're going to die dies, and no one does anything. Then you have a buildup of you and I, and then you're like, oh, SHIT, and then you come and see Amy or me, and then we're like, oh, that we got a problem. And so the beauty is, so you've gone from beautiful to not beautiful, ugly, in fact, and now with GPOA planning, you go back to beautiful because it's a reset if it works. Anyway, I won't, again, that's probably another whole session, but that's how it works. It's essentially another non-U.S. person resettling a new trust. So you get a fresh start.
Yeah. And I do want to say that general power of appointment are an extremely complicated area of U.S. estate and gift tax law. So I'm going to say Milan's thing of don't do this at home alone, because the tripwires are vast, yes. But the reward could be quite great. So seek advice, get professional help should you need it. Okay. I also do want to, since you like this one so much, I want to mention, like, I've had situations where the trust, has already been created, but the foreign grantor is still alive, but it's a non-grantor trust. But they are, they could take a distribution out of those trust assets and then just create a new fresh structure. It's kind of in the family of GPOA planning, restructuring.
The only problem there could be if, depending on the jurisdiction, the home tax, where the GPOA, you can, with an appointment, you can avoid that maybe.
Yeah, I would say in 20-something years, I've had 2 situations where that worked in the home jurisdiction. Right. But I want to mention it because I always come out of the gate asking the foreign advisor, hey, can we do this? And then I get shot down and then I try the next thing. So, all right.
I think that one's yours, outbound.
Yeah, I think this was more, it's been a while since I talked. So outbound trust migrations, I think this was just really kind of like a warning, so to speak. Like if you have a U.S. trust that then later in its life fails the court test or the control test, it will become a foreign trust. And there's that. So let me give you an example. I had a client whose dad created a regular old U.S. trust for him. Everybody's U.S. in the situation. And then obviously dad and my client were hunky-dory in their relationship when that happened. And then the years go by and they have a falling out and stop speaking to each other. And then the son decides for one reason or another that he wants a Cook Islands trustee. I think he was doing some sort of paranoid asset protection thing. But anyway, that was an outbound trust migration that caused the trust to become a foreign trust. And then the U.S. dad technically treated as the owner of that trust when he hadn't been before. It was a U.S. non-grantor trust that now fell under the automatic rule of foreign grantor trust. And so technically, dad should have been getting information to start filing the form 3520, 3520A. Now, Milan, I think you said there's a safe harbor from the penalties, right? For grantors in that situation who didn't know that this happened. Okay.
Yeah, it's a little cryptic in there where if you don't, it's under the old notice 9734. Yeah, where if the person is not aware that it's a foreign trust, you can get out of the penalties. But
but not like, what about the tax, right?
Yeah, right. I don't, not the tax, just the severe penalties. Yeah.
So we had to do a whole bunch of, I was advising the trustee on that too. I was like, oh my gosh, what if dad finds out and he gets in trouble? Because they weren't talking to each other. So anyway,
Well, we had a situation, I think it was with a Liechtenstein trust, and there was a minor child in the U.S. who was receiving distributions, and they didn't want to, the settlor, who was a non-U.S. person, didn't want the child to know that the trust existed even,
Yeah.
foundation, and technically a Stiftung. And so the child was receiving these distributions this whole time from a from a Liechtenstein Stiftung, and no reporting.
Yeah. Yeah, I love the family drama and the stuff we do. It's so fun.
Yeah.
Who said this stuff is not exciting?
Yep. It's fun. It's definitely
okay.
fun.
I think I want to just, I'm going to skip old foreign trust because I want you to talk about protective filings, but I will mention.
I want to hit inbound pre-immigration
Yeah.
trust.
Yeah.
Okay.
So did I talk about that or did you?
Either one.
Okay. You go ahead.
Okay. That's fine.
I'll chime in.
You chime in. We'll both do it. That sounds better. So I brought this up because I've experienced this issue many times where for pre-immigration purposes, where you have non-U.S. persons coming into the U.S., there's a rule. Won't get into all the technical details, but basically if you set up a trust 5 years beforehand, you can keep certain assets out of the U.S. tax net if it's set up properly. What I think a lot of drafters who are involved in this, if they're don't have the expertise or experience, and I'm not referring to Amy, of course, is that they don't realize, and this is particularly when you have non-U.S. lawyers drafting, is what happens is if the certain powers and what are the retained power rules are there, the grantor, what they call the grantor trust rules, if those powers exist, like to change the beneficiaries, to exchange assets, those are like buried in the trust document. And so unbeknownst to the person, once they come to the U.S., have moved to the U.S., even though they set this up 5 years beforehand, now they've got a grantor trust. That wasn't the plan. And that's bad planning. So that's something to be really careful about when you're doing pre-immigration trust. Amy, you got some stories to add?
Yeah, if your desire is to have the trust be a foreign non-grantor trust, when your client, i.e. the foreign grantor, becomes a U.S. person, you need a long lead time, 5 years or more, and you got to look at the terms of the trust and make sure that those are fixed beforehand. The reason I say if that's your desire is that, as we know, foreign non-grantor trust status is not necessarily the most preferable thing, and it's kind of better for it to be a grantor trust in many situations. But I have clients who are like, well, I'm on a temporary assignment from, wherever to the U.S., and I'm going back home. Like, I'm not staying here. In those situations, it might be better for that thing to accumulate income for 5-10 years, whatever, and then they go back home. So
that's a great point.
Circumstances.
I was just gonna say, took the words literally right out of my mouth. Facts and circumstances. All right, I'll pass the old foreign trust to you. How does that sound?
Okay. Well, I was kind of wanted to skip it, but basically, a large part of my career is I've come across trusts that were started in 1974, and the laws have changed over the years, and I've had to identify, okay, oh my gosh, well, this is when it became a non-grantor trust, and this is when accumulation started, blah, blah, blah. So just throwing that out there, that we had a change of rules, and some of these trusts are old.
Well, that, if you don't mind, I'm going to add on to that point, because you were talking about the accumulation, and we didn't get into it because it is technical on the default rule. I think both of us have experienced this, where there are a lot of old trusts out there. U.S. persons have now come into the picture, whether intentionally or unintentionally, and now there's UNI. And for me, on the accounting, trying to do the form side, one of the biggest challenges is actually getting the records, because they're so old, we don't have the records. And sometimes we're forced into the default rule without getting into how that works, the mechanism. But there are also strategies to maximize if you are stuck in that default rule position. There's none of these other mitigation techniques that work. There's ways to deal with the default rule and maximize that too.
Good point.
We got a minute, so maybe I can just do a quick on the boring reporting stuff, there is one kind of interesting technique that both Amy and I have used, and sometimes forms can be your friend. And what we call protective filing. Sometimes you actually want to tell the IRS, hey, here's something that I did and I'm reporting it to you. And Amy, why do we want the protective filing?
Statute of limitations.
Bingo, bingo.
SOL, so you're not SOL.
So you're not SOL. Statute of limitations means how far back the IRS can go back and review returns. If you file a protective filing, even though you might not have been required to do so, the clock starts ticking as to how much time the IRS has to review it. If you don't file it, even if you didn't, and it turns out you were supposed to, the IRS can come back indefinitely.
Anytime.
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 Well, that is it. We hit 1 hour. I want to thank, fantastic job, Amy.
Oh, we
Thank
did
you.
it.
Yeah, congratulations. That was impressive. I hope everyone enjoyed it. As I mentioned, I'm going to be in Berlin next week. So if you are going to be attending there, I hope to meet you in person. For those of you that I just met at Step Latam, it was great meeting you, and thank you for attending today. I think our contact information, if you have further questions, feel free to contact either one of us. We're happy to talk about this all day long.
Thank you.
Thank you, Amy.
Bye-bye.